Welcome back, Ohana.
Ohana means family. Family means nobody
gets left behind.
Here are 5 common financial mistakes and steps you can take to avoid them. 5. Not having credit monitoring services. With all the advancement in technology, it's easy for someone to fraudulently charge something on your accounts, open an account in your name, or steal your identity. While freezing your credit can protect you, the simplest way to catch any fraudulent activity in your name is to sign up for a credit monitoring service that does the work for you and immediately alerts you of any potential danger. There are a bunch of free credit monitoring resources out there. Make sure to select top-ranked credit monitoring services and top identity theft protection services. A few I would recommend are 1. CreditWise from Capital One is ranked as the best overall free service for credit monitoring because it offers dark web scanning and social security number tracking, plus a credit score simulator tool. 2. IdentityForce ranked as the best overall identity theft services for offering the most extensive security features that monitor your information on the dark web, court records, and social media. 4. Not having an emergency fund. 2020 taught us a lot about finances. One of the most important things, being having an emergency fund to tap into when unexpected events arise, such as a job loss or unplanned medical bills. When you don't have any extra cash set aside, you're forced to use expensive ways to finance your life. This can include racking up high-interest credit card debt, taking out a cash advance, or relying on payday loans. Accessing many of these financing options will also be tied to what kind of credit score you have. Your credit score helps lenders decide how much credit to give you and what interest rate to charge you. If you have a low score, you might not get the best rates. If you're just beginning to build up an emergency fund, I suggest starting off small. Even saving a small amount, such as $30 a week, will yield $1,300 at the end of the year. So, you could open a high-yield savings account to start your emergency fund. High-yield savings accounts earn you more interest than a traditional savings, and the best ones have no fees or balance minimums. The Marcus by Goldman Sachs High-Yield Online Savings, for example, is ranked as one of the best because it offers no fees whatsoever and easy mobile access. 3. Missing out on employer matching contributions. This is a common money mistake, especially for younger people. If your employer offers a 401k match program, you should make sure you contribute at least up to that point so you can take advantage of the full benefit. Employer-sponsored retirement savings accounts also offer tax advantages to help you fund your retirement by having you make pre-tax contributions from each paycheck. By not contributing, you're essentially leaving that free money on the table. Any little contribution helps, and the earlier you get started in life, the better off you'll be. You should also consider making a bigger contribution if you can. Oftentimes, people may think that they're putting in the max for their 401k plan once they reach 100% of their company's match. But the true maximum contribution for any individual is $19,500 per year, and an extra $6,500 per year in catch-up contributions for those aged 50 and over. 2. Keeping up with the Jones syndrome. Keeping up with the Jones is a common term referring to allowing yourself to undergo a lifestyle creep. When your income increases, it's not surprising for you to find yourself spending more often than you used to. Rather than buying expensive new things when you can afford them, take that extra money and prioritize your short and long-term financial goals first. We've all heard this logic before: I make more money now, so I can afford it. I worked hard for this salary increase, I deserve it. While celebrating milestones can create a positive feedback loop to help you reach your long-term goals, this thinking can lead someone to overspending their newfound wealth. Make sure you have a plan for any increases in salary or bonuses, such as paying down debt or increasing your savings. Then any extra can be used to improve your standard of living. Most importantly, having a plan gives you a reason to say no, so that you may say yes to something in the future. Get off social media, where people tend to constantly compare themselves to others. That might help you out with avoiding a lifestyle creep. When we bombard ourselves with images of others' best lives, it is hard to not yearn for more. Know that spending more on consumer products won't make you happier in the long run. Instead, focus on social connections, experiences, and giving back when you can. 1. Paying off the wrong debt first. If you have student loans, a car payment, credit card debt and a mortgage, it can be hard to know what to tackle first. I find that many individuals pay extra toward their mortgage with a rate of 3% instead of their student or car loans that often have much higher interest rates. When working on your debt payoff plan, start by writing down all your balances and the corresponding interest rates. I recommend tackling your highest interest rate debt first, like credit cards, then moving on to lower rate debt, like mortgages. I encourage people to treat credit card debt with a sense of urgency, at times even pausing retirement contributions until they can get their balances under control. Paying them off not only improves your credit score, but also frees up room in your budget to contribute more towards savings and investments. Paying off your high-interest debt also helps you save in more ways than one. It's impossible to save money when you're paying more in interest fees on debt than you are saving each month. You could consider a balance transfer to accelerate your credit card debt payoff. Balance transfer credit cards offer introductory zero-interest periods so that you have more time to pay off your credit card balances while avoiding accruing any additional interest. The U.S. Bank Visa Platinum Card comes with 20 months of no interest on balance transfers and purchases, plus no annual fee. Thanks, and be sure to subscribe.